And that's where the role of financial market has a significant contribution to make when it comes to channelizing the funds to the most efficient investors and foster the entrepreneurial innovations. So to discuss that panel, we have another set of eminent speakers. We already have Mahalingam sir, who's already there virtually with us. And I'm going to introduce two more speakers and invite them to the stage. We have the pleasure of Mr. Neeraj Gambhir's presence. He is here with us virtually. He is the Group Executive, Treasury Markets and Wholesale Banking Products of Axis Bank since May 2020. Previously, he was the Managing Director and Head of Fixed Income for Nomura Holding. Mr. Gambhir is a board member and former chairman of FIMDA. He was also the Vice Chairman of the task force set up by Ministry of Finance, Government of India for establishing a public debt management office in India. Mr. Gambhir holds a Bachelor of Engineering degree in Computer Science and is a postgraduate in Business Management from Indian Institute of Management, Lucknow, where he was awarded PGP Chairman's Medal. Welcome, Mr. Neeraj Gambhir. And I would like to now invite Aarti Ramakrishnan, who is here with us in person. Welcome on the stage, madam. Aarti is a seasoned investment banker and private investor with over 20 years of experience with leading global institutions. As country head, India and Middle East at Crystal, she is responsible for growing and scaling the India and Middle East business across the products. Aarti is also passionate about mentoring and grooming leaders to enable businesses to achieve exponential scale. She is a gold medalist from National Law School and holds an MBA from IIM Kolkata. Once again, welcome all of you. And Anant, with your permission, I'm going to accompany Aarti next to her on the dais. Thank you.
Thank you so much, Malik, and thank you for doing the honors. And special thanks to Aarti for being there physically while the rest of us chose to join kind of virtually. In the interest of time, I'm going to dive straight away into the topic. We've got three very, very eminent and seasoned panelists, and I'm sure we're all waiting to hear from them. Role of financial markets is an extremely broad topic. The good thing about topics chosen by Malik and the Almas group is that you can fit elephants into them peacefully, depending upon what your preference is. But what we'll try and do is channel the discussion around a few points which I had in mind. Some of these we've already discussed, so it will be a case of regurgitating stuff that we've already discussed, including Mr. Mahalingam, the keynote address. But nevertheless, I think these are important issues that we would love to hear everybody's viewpoints on. First is the old point about corporate bond markets in India. As long as I can remember, and since I had a lot more hair in my head, we've been discussing corporate bond markets, but I think that discussion is endless and continues. And clearly, we need more thoughts in the current context. Second, I thought we would pick up currency markets to the point that Mr. Padmanabhan made earlier. There is the deputy governor in RBI talked about the possibility of exploring increased capital account convertibility. That has ramifications for people as investors, that has ramifications for monetary policy, that has ramifications for infrastructure investments, and so on and so forth. So I think that's a topic which is, again, worth discussing in the realm of financial markets and growth. Third is the whole aspect of new instruments. Now, some of them are no longer so new, but things like InvITs and REITs, and maybe even special ways in which we can finance ESG and infrastructure. I think that, again, is a topic which is rich, merits a lot of discussions. Mr. Mahalingam and Neeraj, I know, have strong views on this one. And finally, the overall question of how do we balance risk? Malik mentioned savers need return, they need safety, infrastructure needs funding, and it involves risk. How do you manage these two competing requirements of return and risk from both the savers perspective and the infrastructure perspective? And in that discussion, we will try and cover things like what should be the rules for institutional investors. Should they be given more freedom to invest? And then we will talk about some issues like 81 bonds and the past experiences that we've had. Lot of ground to cover. Start with you straight away. And I'm going to start with a topic which you already covered to some extent in your various addresses, corporate bond markets. You heard Mr. Padmanabhan speak about RBI, etc. We know, sir, that secondary market liquidity is low in comparison to the size of holdings of mutual funds and the total outstanding in corporate bonds. We also know that all regulators are pushing in issuers to go towards corporate bonds. You've proposed a whole set of ways of deepening corporate bond markets while you were at SEBI. Maybe you want to talk about them and the path forward for corporate bond markets as a starting point. Sir, you're on mute, sir.
Thank you very much, Anand. Thank you, Almas, for this opportunity once again to interact in the panel. Anand, you broached a very important question about the corporate bond market, but as you very rightly said, and Padmanabhan also said, I think we have been discussing this for the last about 3 decades. And it's a very sorry state of affair that we haven't found yet a solution to this about how to activate the secondary market. To me, it appears that there are ingredients in place to activate this market. But to put it bluntly, I think there are some turf issues which are coming in the way. And these turf issues I would highlight as we go along. But then I feel that unless we get over these turf issues between the regulators, perhaps we are not going to see the light at the end of the tunnel. This is the starting point that I would like to make. I'm not going to take too much time. I'm just going to capsule some of my points out here. And then if you have some further questions or other panel members react to that, maybe I'll have some other views on that. First of all, as far as the investors are concerned, I think I personally feel as far as the corporate bond markets are concerned, and that too when the long-term bonds are going to be issued, the investors from the insurance universe should be coming forward to invest in these bonds without any hesitation. Now, I'm not talking about a bond which is below investment grade. For the time being, I'm confining my discussion to bonds which are just above investment grade, which means AAA and down below, right up to the investment grade bonds. Unfortunately, today, whether it is the insurance regulatory authority or the pension funds regulatory authority, they have not come out with very clear guidelines saying that the pension funds and the insurance fund can invest in these bonds. Now, while they may not be prohibited explicitly, but there is no explicit permission from the regulator, makes, I think, the individual entities to be hesitant about investing in this. I don't think it's a fund management decision. It is still a kind of a regulatory, it's a perception about what the regulator would say. I think there is a need for the regulator to come out in the open and say, look, you can go ahead in these investments. You have to be very clear and explicit about it. Second, as far as the issuers are concerned, I still feel the issuers are mainly the banking and the BFSI sector. It's not coming forth from the other sectors at all. And the issues are more private placements and less of public issues. I think we need to do something about it here. I think SEBI has to come forward and SEBI has to relax the guidelines as far as public issuance of bonds is concerned. While we cannot compromise on transparency and disclosures, at the same time, I don't think we can make it burdensome and a costly proposition for the issuers to come up with all kinds of filings in a way that it is going to make it very cumbersome. In fact, we need to have some one-off filing which can serve as a shelf life for about 1 year or 2 years or something like that, so that people can do one filing and that too a very concise filing, which means I think we are getting to a point what Anant mentioned very clearly even earlier, that perhaps we are going to leave it more to the investors to guess whether he should get into the bonds or not on the basis of disclosures made, assuming that the disclosures are absolutely correct. So which means investor will use his discretion rather than the regulator actually jumping to protect him. Actually, I think we are now reached a point where the investor is perhaps reasonably well equipped to do that. Third, I thought that this is a market where actually we don't have any market makers at all. I think we need to have market makers. In fact, if we can trace back the history of the GSEC market way back to 1995-96 when the primary dealers were introduced, the government securities markets are pretty dormant till then. And the primary dealers actually kick-started the market. Of course, not only they played a role, it's the NDS home, it played a role, which was an order matching system again. Now, again, here I come back to exchange versus OTC. which is a very, very ripe area for SEBI versus RBI. I have a feeling that we need to sync these differences. We need to think alike as to what is going to be good for the market. If it is going to be an exchange traded market, let it be an exchange traded market. If it is going to be an OTC market, let us go by what the Pittsburgh G20 summit said, that, okay, even the OTC markets will have to have all the margining mechanisms and all that in place, which means it is as good as an exchange traded market. So in fact, if you ask my view, while I have spent 35 years in RBI and 5 years in SEBI, my view on this is favoring SEBI. I felt that actually an exchange traded market here would be a little more conducive on the angle that, number one, the infrastructure is in place. And number two, in a way, the Clearing Corporation of India, although it is being specifically kept out of the ambit of the exchange, what it is doing is kind of an exchange only. I mean, the kind of activity that Clearing Corporation is doing is a kind of an exchange. So we need to replicate that as far as the corporate bond is concerned with the market makers, and these market makers could be the primary dealers in the government securities themselves because they are well versed in their activity. Now, if the government or the RBI feels the primary dealers are going to lose their focus by actually spreading their focus on corporate bonds, I feel they are wrong. I'm just not in agreement with that at all. The primary dealers have enormous capacity, not only to focus on the government securities market, they can actually focus on the corporate bond market, which means this primary dealers, number one, the existing primary dealers will have to step in as the primary dealers for the corporate bonds. Plus, I think we need to clear the entry barriers for more newer people to enter so that they can play the role of a market maker. Of course, when somebody is going to play the role of a market maker, number one, who is going to fund him? How is he going to hold that kind of an inventory? Now, this is where actually we were thinking through in SEBI, which of course, again, I put forward a unconventional view, which RBI would not like, is that I think in the LAF, I think we need to start with AAA rated bonds being accepted as collaterals. I don't know what is so repulsive about it at all. I mean, you can't come out with an argument saying that law doesn't provide for it. Law provides for what the human being intends. So if we want to amend the law, we need to amend the law. I mean, we can't eternally give out a reason the law doesn't provide for it at all. I feel the central banker setting an example of accepting the AAA rated collaterals as collaterals for LAF will be an excellent starting point for the market to gain confidence about the corporate bonds. That's going to be very essential. I leave the rest to the central bank. The central bank can have its own filter, parameters and all that. But like I mentioned in the keynote address, if central bank can actually jump into the bandwagon of state government securities being bought in the open market operation, which I think is a beautiful move, excellent move. I think they should follow a similar thing here too. I think they should open up the whole thing. In fact, in the absence of that, I think SEBI was constrained. SEBI had to think in terms of a repo corporation, and the repo corporation, for all we can think of, is going to be constrained by money. It doesn't have access to central bank money at all. Since central bank has access to indefinite amount of money, obviously what the central bank can extend by way of a repo, the repo corporation cannot do. But then I think we have put across a proposal in SEBI, which is fairly decent, that perhaps if it is given life to in the form in which it has been encapsulated, my feeling that that could be a takeoff point for this. And the last point, just I would like to finish off with this, is the backstop facility. Now, this is a point which has been engaging the attention of SEBI for a very long time in the wake of Franklin Templeton. We saw in Franklin Templeton, the illiquid bonds that ultimately they were not tradable at all, and the mutual fund came to grief out of that. Now, here clearly, in my view, again, this is my personal view, the mutual fund regulations will have to go through a sea change. I am not for one who would propose that the mutual funds can go ahead and invest in a typical loan called by a proxy called bond. It's a loan. I would simply say it's a loan, and it is given a name, which is given a decent name bond. I feel mutual funds should not have space to invest in this at all. If at all they want to invest, they have to be listed, which means adequate amount of transparency and disclosures will have to be there. While all listed securities may not have liquidity, at least listing is a first step where the mutual fund should take a part. Now, when bespoke securities became the space in which the mutual fund started investing, I think illiquidity became the byword. And that's where one of the mutual funds came to be. Now, this is where we talked about the backstop facility, but I'm very unhappy to say nothing much has progressed as far as the backstop facility is concerned. I think what we need is a good amount of money as a backing from anybody. I'm saying it could be Reserve Bank, it could be Government of India, who would be willing to pull in a good amount of corpus, and that corpus could be leveraged, at least in times of crisis, to give liquidity to those kinds of bonds. I'm not elaborating the further modalities for the want of time, but I think this is in brief. I just wanted to touch on the corporate bonds. Thank you, Anand.
Thank you, Mr. Mahalingam. And I was smiling while you were speaking because I'm sure Neeraj will agree with me. The candor that you bring on board, despite being a regulator, is just breathtaking. I'm supposed to be an independent academic. Even I sometimes choose my words carefully, but just hearing the way in which you speak is just absolutely brilliant. I'm tempted to ask you a follow-up question, but I will do that after speaking to Aarti and to Neeraj, because you brought some excellent points. I love the way you started off by characterizing this as a turf war. All of us say this in water cooler chats, but you brought it out in the open in a very, very clear fashion. I think the prescriptions that you give, market maker, primary dealers, repo corporation, backstop facility, LAF, at least to a former market participant like me, make a lot of sense. I do have questions about why is it that the turf wars permeate so much? After all, there is one financial stability board at the top, or there's a government at the top which can make people meet. And second, this point about not changing the law and the aversion to changing the law for LAF, etc. I would love to hear your thoughts on why that's happening. Again, why can't the government take a stand on that? But I'll come to you a little later, sir. Neeraj, I'll come to you next. You heard this excellent address from Mr. Mahalingam, where he's covered a whole bunch of points. He's also talked about very briefly allowing investors to make a choice, i.e. Regulators should stop playing the nanny and say, investors are big boys and girls. Let them choose, particularly when we talk about insurance companies, pension funds, etc. I would love to hear your reflections on what Mr. Mahalingam said in respect of the corporate bond market, plus this aspect of risk management. What are your own thoughts, Neeraj?
First of all, thanks to Almas for inviting me for this incredibly interesting and useful chat. I mean, it was like you described it very well. I mean, it was awesome hearing Mr. Mahalingam describe what he just described, right? My perspective on this is not as pessimistic, and I'll say why. If you look at the outstanding of corporate bonds as we speak, it's roughly 35 lakh crores. And it has grown at a very rapid pace. If you see last 5 years data, the CAGR growth of outstanding in corporate bond market is actually is roughly double the CAGR on loan market. And the loans outstanding, and this is all loans outstanding, including retail loans, including corporate loans, is roughly 150 lakh crores, right? So we are already reaching about, I would say about 20 to 25% of the loan market in last about, I mean, and this percentage is actually increased quite rapidly, right? So there is a stock increase that is happening out there. There is a primary market which is actually functioning very well. And it is able to supply about 7 to 10 lakh crore worth of new issuances in terms of financing to a whole host of issuers. So we should not take that away, right? Even to get to this point, I think is an incredible achievement. And just to share with this group, and this is public information, just last week we concluded our single largest transaction. 10,000 crores was raised in a single ticket by an institution, 10-year money. And it was quite incredible to see a 10,000 crore number printed out there for a corporate bond transaction, right? So that's the positive part in my mind. I think we sometimes tend to miss these developments as we go along. Obviously, a lot needs to be done. And I think as before our conversation, Mr. Padmanabhan was alluding to the fact of secondary market. I think the bugbear for us is not the primary market. The bugbear for us is the secondary market. And that is where the point that you made comes very handy, right? Incidentally, in the transaction that I talked about, we saw one of the largest institutions participate and take about 50% of the size, right? But we don't see those institutions for even 1/100th of the size in the secondary market. So I ask myself this question, that why is it that these institutions who are very happy to participate in a primary market transaction to the tunes of 3 to 5,000 crores are not even willing to buy 30 crores or 50 crores in the secondary market. Where is the problem? So that's my point number one. And I think in some senses that stems from the fact that if you look at the charter of most of our large long-term investors, that charter is actually specified in a very non-standard way. I mean, globally, if you see how the pension money is managed and how the long-term money is managed, whether it's retirement money or pension money or these kind of monies, there is an indexation that is involved. It's largely index money, right? So if you talk about any large pension fund, they would typically be indexed to a particular index, which could basically have both corporate bonds and equities. And then they will farm out this money into different asset managers, and each of these asset managers will have their own objectives to meet. And these asset managers will then follow the strategies that they're required to meet to make sure that they are either meeting the index performance or beating the index performance. In India, we actually follow a system where we specify that how much percentage of a portfolio needs to go into government bonds, how much needs to go into PSU bonds, how much needs to go into private sector bonds. And finally, after all that is done, how much can go into other asset classes like InvITs, etc., right? So we have a very, very prescriptive way of telling our institutions how to manage their money. I think time has come for us to revisit this entire edifice. In my opinion, our markets have matured. It's, it's been like about 25 years now, the mutual fund industry is out there. It's now managing 35 lakh crore worth of investors' money. I mean, if we can trust the mutual fund industry to manage 35 lakh crores of investor money, I'm sure we can trust our institutions to figure out what is the best way to do it, right? So I think that edifice certainly needs to change. We need to sort of align ourselves to think about how these large pools of capital should be managed, what should be the performance benchmarking, and an associated, probably very, very politically difficult question is that should they be actually be even giving a fixed rate of return that is centrally decided? Because that actually puts a lot of pressure on the system in terms of where the rates should be, and the associated problem with regard to risk management. So imagine an institution which is required to promise 8.5% despite 10-year government bond being at 6%, right? What kind of assets it will be required to pick up? What kind of investment will be required to make in the name of AAA bonds? I think it's a very, very well understood. And those are the kind of challenges which have actually landed us in problem in the past, right? So to make sure that the returns are well linked to where the markets are, they're indexed to some kind of this thing, and to make sure that this money is actually managed in an index way. And the third and most important point, to make sure that these guys are allowed to churn freely, right? I don't know, but there seems to be some unwritten taboo in the entire long-term, investor space. I can buy, but I cannot sell. So you will see an investor who should actually be buying 30-year bond, buying a 30-year bond, holding it until maturity, which means that he will not sell this bond even if it's 1 year to maturity, right? So if you duration manage the book, then you should be selling the short-dated bonds and buying the long-dated bonds, right? We all know this standard stuff, right? So my point is that we are actually, this is one key area. Yes, Mr. Mahalingam talked about a whole host of changes, and I completely agree. They are very, very important changes. They are all changes linked to creating capacity in the markets, right? But ultimately, markets are about demand and supply. So unless and until we create the right amount of demand with the investors who have right amount of liquidity and right kind of money, I don't think we will have a very active and transparent, secondary market. So those are my, and I felt very strongly about this issue for a very long period of time, and every chance and opportunity that I get, I actually make this point that it's high time for us to move into a more, scientific way of managing long-term money in the system.
Thanks, Neeraj. Absolutely brilliant comments. Frankly, I saw a lot of overlap between what you said and what Mr. Mahalingam said. I don't think you were differing at all. But I'll let Mr. Mahalingam respond to some of the points later. But excellent comments. And I totally buy your point about moving away from prescriptive regulations as far as regulators are concerned, and allowing freedom to investment managers to manage their portfolio as professional people with fiduciary responsibilities, etc. And I'm sure Mr. Mahalingam would agree with that as well. But let me come to you, Aarti, and thank you for being patient, and apologies for taking such a long time. I'm going to ask you related questions to this topic that we're discussing right now. And I would like you to, if possible, focus from an investor perspective, because you understand investors in your current role a lot. Let's talk about corporate bond markets, and Mr. Mahalingam gave a whole set of suggestions about how to improve the secondary market liquidity and how to improve the overall texture of the market. First question to you is, why aren't retail customers really getting more involved in bond markets, both corporate bond and in government securities? We now have retailing of government securities as well. Is it purely a tax issue, or there are other issues as well? Is there a possibility that bond trading becomes as exciting and rampant for retail investors as equity does? So that's the first set of questions. Second is, Neeraj was talking about prescriptive regulations being replaced by principle-based regulations. And Mr. Mahalingam made the point that investors are now big boys and girls and allow them to invest freely. Would you buy that argument at all? Investors have had some few bad experiences in terms of AT1 bonds, et cetera, et cetera. Do you think the market is now ready for investors, and especially the small investors, to be able to stand on their own feet? Or do you think the regulator needs to ensure that they play the role of Big Brother watching over the safety of their investments? Over to you. Any other comments, Aarti? All yours. The floor is yours.
Thanks. Am I audible? Okay, hi. Firstly, thank you so much to Almus and to this eminent panel, Mr. Mahalingam, Neeraj, Anant. It's really a delight to be here, and actually a delight to be here physically. We have a packed hall, and really quite thrilled to see that. I was in two minds in terms of what physical attendance would be. We do live in a strange world, but it's really nice to see the sort of vibrancy and energy over here. So kudos to Almus on that one. So both very good questions, Anant, and excellent points made by both Mr. Mahalingam and Neeraj. And I do often ask myself this question, right, which is that there are strategic areas of high priority, whether they are infrastructure, whether they are mortgages, which all require long tenor financing, right? That's on the one hand. On the other hand, you do have pools of capital, both institutional and retail, which are looking at stable, long tenor streams of yield. Why are we not able to match the two? It's a pretty simple question. And I think a couple of things, right? Mr. Mahalingam made some excellent points in terms of transparency and disclosure and really opening up, the bond markets to retail investors. Certainly, transparency. I think, firstly, the understanding of bond markets in the retail mind is relatively a lot more limited when you compare it to equity, right? And that is possibly because credit and credit risk is not something that is fully understood. A retail investor places very high reliance on a rating agency when determining whether this risk is something which is worth an 8.5% return. So tax, if you ask me, is the smallest aspect, right? You have a large amount of retail savings sitting in savings bank accounts, paying the same amount of tax on fixed deposit interest. So really the bigger question is, how do we bring about the confidence? And there are 2 or 3 excellent points that have been made, but how do we bring about confidence in the retail mind to say that, your money is safe at 8.5%, you're getting paid a little more than a fixed deposit. This is the incremental risk that you're taking. But really it is not, the likelihood that you will lose your principal is not very high. We haven't been able to instill that confidence because of various events that have taken place that we all know very well about. But there are a couple of things. One is transparency and disclosure. The second is faith that a retail investor can place reliance on a rating agency's determination. And I think a lot has happened on that front. Anant, I know you're associated with a very leading rating agency. A lot has happened on that front, I'd say, in the last 3 or 4 years, right? And lastly, the question is there a way to credit enhance, right? So if we have a basket of long tenor bonds, let's say for an affordable housing or an infrastructure business, which are, I would say, strategic priorities for policymakers, is there a way to put it in a basket and really credit enhance it so that it can be packaged and sold down, right? The US does this very effectively with the Fannie Mae's and the Freddie Macs, and they have a liquid mortgage market notwithstanding the global financial crisis. But there's a very, very effective way, I would say, with a combination of disclosure plus perhaps backstop / credit enhancement, and clarity in terms of reliance on rating agency determinations to be able to funnel retail savings. Today, every high net worth and retail investor we speak to is really thinking about how do I get income into my portfolio, right? I'm sitting in a highly valued equity market and I need to diversify. But the only reason I continue to put money into equities really is because today inflation is possibly higher than my fixed deposit return net of taxes. So I think excellent points made, and there is a lot of food for thought in terms of what we could do for the long tenor bond market, particularly since issuers are typically, the funding is really going into very large strategic priorities for the country. And like I said, infrastructure and affordable housing have been pet passions for me. So I really like this topic from that point of view. Thanks, Anand.
Thanks, Aarti. I'm going to stay with you for a second for the next round as well. So you make an excellent point about the potential for MBS mortgage-backed securities in India and something along the lines of Fannie Mae, Freddie Mac, given the need for housing in this country. But on the point about infrastructure financing, I want to segue to another related topic, which is the whole question of InvITs and REITs. So are you seeing retail interest, especially HNI interest, in these instruments growing? Do you see the need for actually mutual funds are already allowed to invest in these instruments? But to the point that Neeraj was making earlier and Mr. Mahalingam was making earlier, should the institutional investors who are investing on behalf of retail investors be allowed a lot more freedom in choosing these instruments, subject to their own due diligence, etc.? Do you think the market is ready? And what would you suggest are policy changes required to make these instruments a lot more popular than they already are?
Sure. So let me anecdotally share here, Anand. So Crystal is actually, we're a digital private bank. We're Singapore headquartered, and what we basically do is we partner banks globally, including banks in India, to help their customers really create global wealth pools. And I'll tell you what we're seeing there, because we're Singapore headquartered. We are seeing that, both HNI as well as retail investors are a lot more aware and a lot more educated than we imagined, right? So we have a Singapore REIT product on the platform. And the number of interested investors that we see, both Indian retail, Indian HNI, who are able to really discern that this is a very quality underlying, because they understand what the quality of the underlying asset is, what the yield stream looks like, and consequently what the dollar denominated yield is that they can make. So, arguably, if we are seeing interest in that kind of asset class coming from an Indian retail or HNI investor, there's no reason why the same would not hold true for a domestic InvIT or REIT product. So, echoing Neeraj's thoughts there, right? I think we have a very sophisticated mutual fund and insurance sort of investment mandate there, right? You have CIOs that have managed billions of dollars over, I would argue, close to 3 decades. And therefore, it is time for a paradigm shift in terms of how we think about, or how regulators think about, permitting a less prescriptive approach, and really permitting institutions to structure their own investment mandates in order to be able to access these products more freely.
Thanks, Aarti. Mr. Mahalingam, I'm going to come back to you now. Any comments on what you've heard so far? And specifically, I have a few questions for you. One is coming back to your point that you started with, which is on turf issues. Again, breathtakingly good to hear you speak about it openly. The question, sir, I have is a little naive, which is why can't these turf issues be resolved, maybe at the government level or at the Financial Stability Board level? And what is the real politic behind that particular issue not getting resolved? To the point you made about OTC, Pittsburgh versus exchange, etc. Love to hear your thoughts on that. Second related thought, while the Khan Committee itself talked about allowing LAF, AAA bonds to be allowed as part of LAF reverse repo, you made the point that we've taken a long time, we've dragged our feet a long time in getting this done. And there seems to be, as you put it, a sense of distaste within the regulator, RBI, to actually dip its feet into corporate bond markets, either in intervention or in LAF, simple LAF repo. Again, what are your thoughts on why this is happening and how this could be addressed? And the final question, sir, is the point that Aarti made on InvITs and REITs. We are aware that we have this very, very large and ambitious national infrastructure pipeline, and we have a national monetization pipeline as well, both of which require many of these new instruments, not so new now, but many of these instruments to become a lot more prolific than they are currently. Do you think the ecosystem is ready to expand and proliferate InvITs and REITs and maybe even MBS that Aarti mentioned? Or do you think that the system is taking too long a time to actually make these instruments a lot more popular? Or any other comments?
Excellent questions, Anand. To start off with REITs and InvITs, one thing I would say is, okay, these instruments are not so old right now. I think they are hardly about 4 years old. I would tend to give them a little more time for the retail investors to understand and expand the universe of the market to include the retail investors. But I completely agree with Aarti as far as this is concerned. 2 points that she made, and I agree with both those points. Number one, rather than a very highly prescriptive regulation in these areas, I'm talking about the areas related to mutual fund investors and all, not relating to REITs and InvITs. REITs and InvITs are relatively new. So I don't mind a little bit of a prescriptive regulation out there. But as far as the mutual funds are concerned, that's a mature industry today. So I have a feeling that we need to really start the shift from a prescriptive regulation to a principle-based regulation as far as this industry is concerned. What does that mean? I mean, when we all talk about this principle to, prescriptive to principle, what do we mean? Do we come up with motherhood statements as far as regulators are concerned and leave it at that? Is it the question that we are trying to argue? No, I would simply say, while there will be motherhood statements on the regulators that an industry is expected to do this, I think a good part of the gap in terms of prescriptive regulations and compliance expected would be filled up by transparency and disclosure, which means a whole lot of disclosures that needs to be forthcoming from the intending issuer, intending person who is going to garner the public funds, that he is going to put it out in the public domain, that this is what I'm going to invest in. This is the strategy that I'm going to adopt, and I'm not going to swerve away from this strategy. And he has to be truthful to his statement that if there is some problem mismatch between the name and the action, he is liable for action from the regulator. That's my idea of a regulator today as it evolves as far as the matured industries are concerned. That's how I put it, but I don't make it applicable for the REITs and InvITs right now. I would prefer to give another about 4 to 5 years time for REITs and InvITs to mature. I get a feeling that as far as REITs and InvITs are concerned, SEBI has been doing quite a lot in this area to actually bring in more of investors, to relax some of these regulations and all that. Now come back to the Khan committee question of the AAA. Why is it not being included in LAF? Now, to be fair to RBI, to give credit to RBI's view, maybe the government, the RBI feels the banks are having sufficient amount excess SLR securities in their portfolio today. So there is no way that today there is a crying need for the corporate bonds to be included as a part of the LAF collateral universe. Now, even today, if I remember correctly, the excess SLR portfolio, the banking system as a whole is still hovering between 4 to 6%. So as against an 18% SLR. Given that, I think banks have enough capacity to borrow under LAF through the government securities mechanism. But my point is completely different. My point is you make it an enabler. I think tomorrow if a bank wants to go and borrow against it, I think RBI should not have any problem as far as extending LAF against that at all. To say that the law doesn't allow, I still find it as an excuse which doesn't gel at all. I have a feeling the law has to be amended. And when you are going to make the law in terms of the rating and all that, okay, the rating agencies will have to be brought under greater amount of supervisory ambit of the SEBI and the RBI jointly put together, because the rating agencies today rate the bank loans, the rating agencies rate the bonds also. So unless there is a huge amount of cooperation between RBI and SEBI in terms of jointly supervising and regulating the rating agencies, we cannot bring about enough amount of transparency and the faith of the investor in the rating agency. That's going to be very important. So as far as the law amendment is concerned, I reiterate that law amendment is not a big point at all. I have a feeling that RBI has to pilot it and get it done. While today it may not be a crying need because of the excess SLR portfolio, while the government may not accept that when the government goes and borrows about 12 lakh crores every year, perhaps I think they are crowding out in a way the corporate bonds. But I still have a feeling that if we can make this as a part of the repo bucket of the RBI, it will do a world of good.
Thank you, sir. Any comments on the turf issue at all? On why it's still persisting for such a long time?
I really don't have an answer for that.
Okay.
Absolutely, I don't have an answer. I confess my ignorance there. Although I have been a part of both the regulators, I have a feeling that this is something which could have been easily resolved, provided people sit across the table and discuss what could be done and what cannot be done.
Anyway, as a person who has straddled both places, sir, I'm still hoping that you will continue your efforts to see a meeting of minds coming through, and God will give you the opportunity. Neeraj, I'm going to come to you. We've talked about InvITs, REITs. Aarti mentioned the possibility of mortgage-backed securities. I'm going to come to another area, which is ESG. Clearly that's a focused area for investments along with infrastructure, and they're both connected in many ways. You've successfully raised a very big-sized AT1 bond, ESG compliant in many ways. But are we doing enough for financing what's going to be a huge agenda for ESG compliant? What do you think the ecosystem ought to be doing to ensure channeling of funds towards infrastructure in general and in ESG in particular?
Yeah, Anand, fantastic question. And the short answer is no. We need to do a lot more domestically, considering that we have a very vibrant domestic financing market across loans and bonds, right? And given the kind of momentum that we have seen in terms of ESG-driven investing in the global markets, both in US as well as in Europe, particularly in Europe, right? I don't think we've seen anything close to that in the domestic markets. So if you, let's say, talk about the custodians of large pools of money, whether it's mutual fund industry or whether it's insurance companies, they have not, many of them have not actually put out any thoughts around how do they want to sort of, straddle this space and what preferences are they likely to have when it comes to these kind of investments. On the other hand, I see a very growing need and demand for this kind of financing because clearly, as you mentioned, that move towards 50% renewable energy, right? That's a massive investment that needs to go into renewable. We are already, hearing about agenda, of investment, for example, in hydrogen, and hydrogen-linked assets and hydrogen-linked ecosystem, right? Because that's being seen as another alternative fuel. So there is a lot that I feel will happen over the next 10 to 12 years in developing a carbon neutral footprint, or let's say decarbonization of the entire sort of industrial sector, right? And that requires a massive amount of investment. I think $4 trillion is an estimate that I read somewhere for the US alone. And if you think about India, I think it could be very large as well. So we do need to develop an ecosystem. That ecosystem does require a proactive approach by the domestic investors. Maybe take a cue from what the global investors are doing and how they're basically segregating and segmenting between ESG compliant and non-ESG compliant investments. I still feel that globally itself, this is a very, very new area, right? We've gone through a number of issues. Recently, the whole issue of greenwashing was being talked about. I think that has been put to rest a bit. But I think this entire industry globally also is going through its own, mindset change and churn. And as it evolves and develops, we will see more and more newer practices coming in, and the domestic industry needs to sort of take a leaf out of that and see what we can do locally. For example, I mean, just a last point on that point, and we've seen a number of, let's say, renewable companies come up with bonds. We ourselves did one green bond, right, domestically. But did the green label get us better investor interest? Answer is no, right? So today, if we are doing a green InvIT, for example, will it get us a better domestic interest? I'm not so sure of that. We did our 81, we labeled it sustainable, and that sustainability label did get us a fairly respectable, I would say, interest. It's arguable as to how much price benefit did it bring, but at least there was a reasonable amount of interest to understand what we're trying to say in that. So I'll just pause there. I hope I've answered your question.
No, excellent, Neeraj. It's such a fascinating topic. I would love to dwell more on this and discuss this with the other panelists as well. But there is one big chunk on currency markets that we've not touched upon at all, and I want to get there. before Maulik waves the hand and says this time is up for this panel. I've already extended the welcome too much. So I'm going to quickly segue topics into the currency markets and capital account convertibility. Aarti, I'm going to start with you. There is this speech which the RBI Deputy Governor gave recently, which talked about the possibility of opening up capital account convertibility even more at multiple levels. This has obviously many ramifications for monetary policy, for flows, for capital account flows, and for our own domestic investments. Your thoughts, Aarti, particularly again from an investor perspective or any other perspective as a former banker and financier, what do you think opening up of markets will do? Is it a good thing to aspire for, or do you think there are challenges here?
So, Anand, thanks. I think Mr. Mahalingam touched upon this earlier today, and it really did get me thinking, where he said, inflows should be free and outflows should be calibrated. And I couldn't agree with that more. Capital account convertibility or free flow of currency, good or bad, is going to happen, right? It's a question of, as policymakers and regulators, how we want to keep pace and how we want to maintain the balance. I don't think, the market forces of, as businesses get more globalized, as individuals go more global, capital account convertibility is something which one has to take calibrated steps towards. So I see sort of three very big drivers at an individual level, and I think the same would hold true for Indian businesses as well, right? What is the purpose of the LRS window? What are really Indian residents using the LRS window for? And I think primarily we see three big drivers, right? First being diversification. The awareness that just because I'm an investor in India, there's no reason why I shouldn't have access to the best investment opportunities globally. And if those opportunities happen to be from India, so be it. If they happen to be from Eastern Europe, I should democratically have the same degree of access as an investor anywhere else in the world. So diversification is a very big driver that we see. The second, of course, is like I said, access. I think, we see a lot of thematic interest in, I'd say globally relevant themes, right? ESG is one of them. Lithium could be another. Space exploration could be a third. And the increasing awareness that there are certain global trends that are going to drive development and growth over, let's say, the next decade, and one wants to be invested in them. I see that as a key driver as well. And the third is, of course, end use, right? The fact is Indians are going global. We travel, we educate our children abroad, etc. So, as Mr. Mahalingam said, how do we calibrate this so that we're able to kind of guide outflows, at the same time, give the right kind of access to Indian businesses, individuals that are increasingly going global? I think the one, revolutionary step that I see from the regulator here is on the digital remittances front, right? So RBI, of course, has a regulatory sandbox, and, where they basically allow early stage businesses, many of them startups, to work with revolutionary technologies on how remittances can go completely digital, which means I, sitting in my bedroom, can literally, make $100,000 investment into a complex insurance settlements fund completely digitally. Today, India, Singapore is completely UPI enabled, and things like Money to World, etc., really enable completely digital access. And as we move towards digital currencies globally, I think we do have I'd say a fair degree of progressive thought within the regulator there. And RBI has, of course, a subsidiary called the Innovation Hub, which actually sits right in the middle of all of the startup hub in HSR layout in Bangalore. They're extremely accessible, and it's heartening to see that we are thinking progressively in that direction.
Superb. Thanks, Aarti. Excellent points from an investor perspective as well as from a technology innovation perspective. Mr. Mahalingam, I'm going to come to you next. I'm tempted to go into cryptos, but I will not, because if we start talking cryptos, we'll discuss this till 12 o'clock in the afternoon and Maulik will ban us forever. But on the subject of capital account convertibility, sir, Aarti put the perspective of the need for diversification, Indians to save abroad and so on and so forth. But you made the very interesting point about needing to calibrate outflows. My fundamental question, sir, is we still have a large current account deficit, barring the last year, which was an aberration. We still, and in fact, we import a lot of manufactured goods and a lot of goods for consumption. And our basic balance seems to be large consumption-oriented current account deficit funded by capital inflows, which while we have record levels of reserves and therefore things look okay, at a fundamental level, doesn't look like a great balance. At a time like this, does it make sense to actually encourage capital account convertibility at all? And what do you see as the policy ramifications, including on monetary policy, from this particular issue?
No, I think, Anand, you hit the nail on the head when you gave the example that when we have a huge current account imbalance, of course, last year being a kind of an aberration, do we need to encourage capital account convertibility? I think that's the real answer to the question that we are talking about. I'm not saying that we need to reach a current account surplus state to encourage capital account, convertibility. All that I was trying to hint is, number one, our current account today, go back to normal times. I'm not talking about the recent times. We had a kind of a current account deficit of close to about 2 to 2.5%. I'm again not talking about 2013 when we hit 4.8%, which is very, very high. So anything which is going to be in the range of close to about $100 billion is going to be entering the unsustainable zone as far as India is concerned. So that being a very important balance indicator, plus the fact that our entire foreign exchange reserves are borrowed reserves. So the question that arises in our mind is, we are not people who are owning our reserves. Do we allow people to take out the money as and when they feel like? Is this something which is sustainable as far as the country is concerned? There are two ways of arguing this question. If we open up the capital account even for outflows, maybe it brings out a kind of a regulatory, a kind of a market burden on the government to manage its macros very responsibly. That is one answer to the question. But what if the government continues to be driven more by the political will rather than by the economic will? If that is going to be the thing, then it is going to be a recipe for economic chaos. So this is where I would like to err on the side of caution. While I would definitely prefer an open capital account, even in terms of outflows, but I would say that the term that I would prescribe for this is medium to long term. It could be 5 to 10 years, depending upon how the macros turn out. Whereas for the inflows, there are areas, pinpricks, which we should remove all the way so that we can encourage the inflows. But the related question that you raised very rightly, what if we encourage the inflows and put some kind of caps on the outflows? Does it not provide for asymmetry, which creates a problem of managing inflows in the country? Now, this I was mentioning the keynote address. To my mind, it appears that RBI is well equipped to manage the inflows. Now, way back in 2004, when we introduced a market stabilization scheme with the agreement from the government would actually pay for the coupons of those bonds which have been issued. It was a classic case of an excellent understanding between the government and the RBI. So basically, I feel that today, if the RBI is going to buy out all those kinds of inflows and then store it up in the foreign exchange reserves and incur some cost, it's fine. I think we need to incur that cost for the sake of macroeconomic stability. Until we reach a point where actually we feel that the country's macroeconomic indicators are reasonably good, the external sector indicators are reasonable, I think opening up the capital account on the outflow side may be a little premature. I'm making a very cautious comment.
No, excellent, sir. Thanks for those inputs. I'll definitely move to Neeraj and check with him whether he agrees with your way of looking at it. One quick question, sir, related to this, staying with you, is on monetary policy implications.
Yeah.
You talked about, sir, the opening up of Indian bonds into global indices as well as something implicit and happening. As we become more and more open, and that seems to be the direction forward, that impossible trinity comes into the picture again, where you can't have independent monetary policy, free capital flows, and a stable currency altogether. Do you see that as a constraint at all, especially since we have a monetary policy framework which is purely domestic inflation oriented? Or do you think it is something that the RBI can easily manage, as you rightly mentioned, by managing its reserves?
In fact, I still feel that the impossible trinity is a kind of a possible trinity for RBI. It's not so impossible as it is made out to be. Now, one is clearly we want monetary policy independence. We don't want any kind of a restriction on that. As far as the capital flow is concerned, if we think that, okay, we need to be open on the capital account, at least as far as the inflows are concerned, that's also going to pose a question because large inflows are going to accumulate. So the only thing which is going to be left out there is exchange rate. Now, in terms of exchange rate stability, actually, basically we can't guarantee exchange rate stability. There could be some amount of volatility within the constraints as RBI has for itself. But that amount of exchange rate volatility we can live with. The industry in India can live with that.
Thank you so much, sir. Neeraj, I'm going to come to you for the closing comments on this particular section. So the way I heard Aarti, she was arguing for access from an investor perspective, new areas, new vistas, currency diversification, and so on and so forth. Mr. Mahalingam was striking a note of caution and suggesting that maybe we should be careful about outflows given the nature of our current account. Where do you stand on all of this, Neeraj? Particularly from two perspectives, I guess. One is the fact that India does need investments for funding our infrastructure requirements and all of that. And second, is it really possible to open the doors for inflows and close the doors for outflows? That asymmetry that Mr. Mahalingam mentioned, is that really sustainable in the long run? Comments are all yours.
Thanks, Anand. So my perspective on this is that convertibility is a journey. And as an emerging economy, right? As long as we are in quote unquote emerging economy, we will be on this journey. The degrees will keep on changing as the sophistication of the market, sophistication of the players, our balance of payments and balance of overall sort of macroeconomic parameters change and evolve. I think over the last 2 to 3 years, I would say particularly very recently, we made some significant steps towards enhancing that convertibility, right? I would like to sort of call out two. One is the access being given to the domestic banks to participate in the NDF market. I think that brings the two markets, that was NDFs, if you recall from your old currency trading days, was always the unsaid, unspoken word that we all used to hush about but never talk about. So I think now that it has been acknowledged, recognized, access given, it's a huge step taken forward. The second, I think the whole index inclusion, right? And for a long period of time, we have all argued about whether the foreigners should be allowed to buy Indian debt, particularly the sovereign debt, how much they should be allowed. This was a huge, I would say, convertibility parameter that has over a period of time been steadily sort of opened up, and now more and more access is being given. And I think as the index inclusion happens, that will also sort of widen up. The remaining sort of areas where you could say that your convertibility has more ways to go. One is the access being given to residents to hold, basically, let's say foreign currency assets. And the second is the access being given to non-residents to hold domestic assets, particularly the debt instruments, in a bigger way. I would say that I think it will be more of a zigzag kind of a journey for us during the periods that we feel that our current account is well managed or reasonably managed, and we have sufficient confidence around our ability to manage the currency markets. We will see steps being taken to open up the markets a little bit step by step. And during the periods of stress, whether it's a taper tantrum or something else that comes down the line, we could see some steps being taken back, by the regulators to make sure that the markets don't go haywire. I don't see, as an emerging market economy, the central bank completely stepping away from managing the currency. I think that's a given for me for now, right? And given, and you pointed out very well, the nature and the size of our current account deficit does warrant the central bank to be, having a little bit of a cautious attitude towards how much opening can be done and to what extent it can be done. So I think the caution note that has been struck by Mr. Mahalingam, absolutely well taken. I think we need to be quite thoughtful about how and in what form and fashion we go about. Just one last point. I think the addition of Gift City to the entire panoply of the investment sort of ecosystem is a very, very important step as well. While it may not be very large at this current point in time, and depending upon how it evolves, it could also be another factor in thinking about convertibility and how convertibility comes into play for us, right? So I'll just pause there. I hope I've answered your question.
No, absolutely, Neeraj, and thank you for that very comprehensive comments. Okay, now in the interest of time, I'm going to wind down here. I'm going to request each of the three panelists to give their closing comments. I'm going to start with you, Neeraj. And I'm sorry, I'm going to put you on the spot. Given your markets background and your awareness of markets, I'm also going to ask you to do a bit of crystal ball gazing for Indian fixed income markets, both currency and debt. As Mr. Mahalingam was mentioning, we now have trade deficits going regularly about $20 billion. Last month was $23 billion. So it does look like current account deficit, if this trend was to continue, could head towards that $100 billion mark. At the same time, we have plenty of reserves and RBI has plenty of firepower to manage currency volatility. Global markets are all over the place. Your thoughts and your closing comments on what we've discussed so far.
So first of all, thanks a lot for such an engaging conversation, and always a pleasure to be on these panels with you. My commentary is that we are evolving certainly. And I think we are evolving at a fairly rapid pace as an economy and as markets as well, right? I mentioned some statistics, size of the mutual fund industry at 35 lakh crores, outstanding corporate bond market at 35 lakh crores, right? Some significant steps being taken by the regulators to further open up the market, the NDF market opening up, the whole sort of new guidelines around derivative markets, OTC derivative markets, right? IFSCA is thinking about creating a spot gold exchange in Gift City, which is going to be the most prominent spot gold exchange, right? So it kind of clearly tells me that this is the pace of financial market development in this country is only going to be accelerating from here onwards as the size of the economy increases and the needs for the economy increases. I also feel that technology is going to play a very, very big role in financial markets as well. I think we've not touched about that topic in this conversation, but to me, that's a huge topic, and Aarti represents one side of that equation, how technology is going to change how we trade these markets, right? So to my mind, exciting times ahead. I'm very optimistic, as I said, both for the economy as well as for the financial markets. And I think the index inclusion, particularly in the near term, index inclusion is a really important milestone for us to sort of think about as to what it brings with us. I feel that it will bring a lot more awareness amongst global financial investors, large institutional investors about Indian markets. While on the face of it, they will come and buy government bonds. But once the investors start coming in, they will obviously look around and see what else is there. So I do feel that it's a significant step forward for the fixed income markets particularly.
Thanks, Neeraj. Excellent comments as ever, and totally agree with you on the index inclusion point. When I speak to global investors, they echo exactly what you said. Aarti, your closing comments on what we've discussed so far, and any other points that you wanted to make, but I didn't ask the right question. So please, the floor is yours.
Thanks so much, Anant. I completely echo Neeraj's thoughts. It's a real delight to be on a panel of this nature. Mr. Mahalingam, Neeraj, and Anant, stellar job in moderating, makes it very exciting for us. I hope equally interesting for the audience as well. The one thing that really made me introspect is sometimes we are rather self-critical, right, in terms of progress that we are making as an economy, as policymakers, as market participants. But some of the numbers, right, that were mentioned on this discussion made me look back, let's say 30 years. And if you think about it, SEBI as a regulator is not yet 30 years old. So we are a very, very young capital market, in some sense, a young developing economy, right? And when you look at it in that perspective, I think the strides that we've made in terms of disclosure, in terms of financial instruments, in terms of access to various kinds of economic instruments to a widespread retail public, I would say not bad, actually. And therefore, I think when I look ahead, and clearly on the technology front, which is revolutionary, which is game-changing, we have been ahead of the pack, both in terms of talent, in terms of the kind of capital available, in terms of true ideation and innovation. And I'm not sure we've seen a lot of that in India, but we are seeing it now, simply because there's capital available. There's a risk-taking mentality which one sees, and therefore the kind of innovation and ideation that one sees in technology, which is going to have a revolutionary role for economic growth. But of course, that's a completely separate discussion. But given some of those building blocks, I am also just as optimistic, and I think journey is only beginning for us.
Oh, thanks a lot, Aarti, and very, very good, insightful comments. Would love to catch up separately, as you mentioned. Yeah, the quick point on you're absolutely right, and Neeraj is absolutely right. Huge strides, as Mr. Padmanabhan mentioned in his address. We've made a lot of strides on infrastructure as well. But I personally like it when we show angst and we show frustration. I can tell you that a lot of the changes which Mr. Mahalingam spoke about in SEBI, including market maker proposal, including backstop facility, including primary dealers, more active participation, etc., and mutual fund being freed up, etc., happened under his watch. So having that angst and having that candor, I think, helps tremendously in bringing about some of the innovation that you mentioned. Mr. Mahalingam, you're going to have the last word. We've discussed a lot of issues around corporate bond markets, around new instruments in which REITs. We talked about ESG. I didn't ask you to speak about ESG, but if you have any comments there. We talked about institutional investors being given more freedom. And of course, we talked about currency markets. I think we lost you in between for a minute. Neeraj essentially broadly agreed with your approach of taking it cautiously as an emerging market when it comes to opening up the currency markets. But sir, your closing comments from your excellent keynote address to now, any thoughts to summarize the discussion so far?
Thanks a lot, Anand. I mean, I was very keen to hear Neeraj's words, but I think the infrastructure of power gave way. That shows we need infrastructure financing in the country. I think about 4 minutes I was out of this entire conversation, but you summarized very nicely about what Neeraj said. I think the conversation has been excellent because I think you are able to frame some very, very relevant and topical questions. And when I gave my views on it, these views were born out of my stint with RBI and SEBI. I think they were candid enough to tell you like where exactly I think RBI and SEBI differed, although I didn't have a solution for it, unfortunately, actually. But then I completely agree with Neeraj that I completely share the hopeful and the positive note that he carries as far as the market development is concerned. Although the pace is slow, my own personal feeling is that the pace could be much faster had it not been for some of these artificial barriers created. When we say a law is not amended, I don't think that should be cited as an excuse anytime at all. So all these things should be in place. When the government comes up with a gold exchange proposal, I mean, they should not wait for the next budget to actually introduce some more laws to enable to take it a final form. I think it should have been thought through and the whole thing should have been in place at least about 6 months from the time the budget announcement is made. But thankfully, again, on the gold exchange front, I would say that a lot more work is taking place and I'm sure that in about another 6 months' time, it will see the light of the day. Now, on the ESG, I think one last comment that I wanted to say was, in my view, although it's a very crude comparison that I'm trying to make, ESG is not new to India because India is known for priority sector advances, actually. I mean, when priority sector advances were introduced at that time, people are not game for the priority sector. They said that what is not oriented, what is not return oriented, why should I invest actually? But ultimately, I say that there is a kind of a E part which is actually coming in there, poverty alleviation. I think poverty alleviation is a part of E part of S part, social as well, because unless the social fabric is intact, perhaps it is going to give way if the overall financing is going to skip that aspect. So why we are used to that. So how we are going to weave in this ESG part with the whole thing by way of either setting the target or by trying to have a self-imposed targets on the respective institutions. I don't know how it is going to pan out, but all that I can say is it is important. The country cannot actually say that, look, I'm going to look at a different path compared to what the globe is looking at. I think the Prime Minister has rightly stressed that in a few years' time, okay, we are going to be net zero emittance kind of a thing. Although the time horizon is long, I think we have to look at that kind of a thing and we have to really implant those implications in the financial sector and work towards that. Thank you very much, Anand. Thank you, Aarti, and thank you, Neeraj. Thank you, Maulik.
Thank you. Thank you so much. This was a brilliant panel discussion. Thank you, Aarti. Thank you, Neeraj. Thank you, Mr. Mahalingam. I could have continued forever, except that I can already see Neeraj, Maulik getting very antsy. So Maulik, the stage is yours. Back to you. And thank you all panelists for a fantastic discussion.